All right, good afternoon, everyone, and welcome to a special Saturday edition of Startup Financial News. This is the first Saturday edition of the program we've ever done, and we are testing it out exclusively for our new YouTube channel. So welcome if you're watching us on YouTube. This will not be on the podcast version of Startup Financial News. It'll only be here on YouTube. So what we're talking about today, folks, we're going to do a special deep dive topic as opposed to doing a full-on show. For those of you that are just joining the Startup Financial News family, the program here, typically what we do on our show is we start with, obviously the date, but what you need to know section of what's going on in news in terms of startups and venture capital. We then transition into today's top headlines, which consist of the 5 most important stories of the day for startup founders, entrepreneurs, venture capital people to know. And then we transition into market performance. We cover the major indices and where they have landed at the close of business for that day. So considering that today's a Saturday and we don't have that information, we don't have that data today, we're going to be talking about a special featured piece, like I said, a deep dive into a story that came out on, or in, rather, the Wall Street Journal today. So front page story on the Wall Street Journal today. I'm going to pull it up on my phone because I don't have the paper version of it today, so bear with me as I pull that up. But the story has to do with the interest rates. The Federal Reserve sets interest rates for the U.S. economy here, and we're going to talk about how that affects not just the world of finance, but the world of venture capital, and ultimately how that trickles down to startup founders and entrepreneurs, and what it means for you and what you have to pay attention to. So the story, as we said, is right here, top story in the Wall Street Journal today. It's a piece, hold up one second, it's a piece that you can pull up on the mobile version, on the desktop version, or in the paper version of the Wall Street Journal today. It'll be on the front page anywhere you pull it up. And the story is titled, Fed Set to Lower Interest Rates by Quarter Point. I'll read you the quick synopsis. Federal Reserve officials signaled they are ready to cut interest rates by a quarter percentage point at their coming meeting, while indicating the potential for additional reductions. So I'm not going to go through and bore you with reading the story. You can read the story on your own, and I'm also not going to bore you with what that can mean for the overall U.S. economy, aside from the fact that there's really not too much likelihood that it's going to lead to anything other than, if nothing else, a short-lived boom. When the Fed cuts interest rates, let's put things into perspective here. What that does is that makes money cheaper, if you will. It makes it easier to borrow. And because money is cheaper and easier to borrow, it is first spent more freely, consumer spending, but also it is invested more freely, okay? So what we're talking about today, we're going to start with what that means for us as startup founders and entrepreneurs, why it's important to pay attention to, and then we're going to transition into the potential upside and downside that could have, so that as an entrepreneur you stay better informed. And it took me a long time to get on this side of the table. And for those of you that don't know my story and why I'm qualified to talk on this, I'm going to tell you briefly. But I am now in the investment banking, venture capital, fundraising world of things. I made the jump. 3-time tech founder. Probably had 5 or 6 companies total, not all tech, but before I kind of made the transition. And with my last company, it was financially over leveraged, and I lost it to really some stupid reasons, to be quite honest, that were totally avoidable. But I didn't know enough about what was going on in finance. And so because of that, not only did I go back to school to get my MBA and a certificate in finance, but when things kind of finally settled for me and I was ready to start my next venture, I said, you know what? I want to change the way that entrepreneurs interface with the world of capital, whether it's venture capital, whether it's private investors, whatever it is. I want to make sure that entrepreneurs have the information that they need in order to properly not just raise that capital, but raise it from the right people and do so at the right rates, right? So the group I run now was formerly called MGI Capital. It's now called North Star, and we help entrepreneurs raise anywhere from $0 really to $5 million in their earliest stages, and then we have relationships that help them raise all the way up to $20-50 million, and then eventually proceed through mergers and acquisitions and IPO. So that's kind of the day-to-day work that I do at North Star, and Startup Financial News was the brainchild originally of MGI Capital, now North Star, which was just kind of a way to get some free information out there and produce this program that covers news in a way that's not covered on the major channels, on the major news stations, if you will, specifically for entrepreneurs. Okay, so that's that's kind of a little bit of the backstory, and the reason and how I kind of got to the point where now I fully understand this stuff is over the last 2 years we've been doing a lot of investment banking work, which really forces you to focus on how overall, not just microeconomic, macroeconomic data points and happenings actually affect the overall economy, and then what that does, how that trickles down to all of us who are players within that economy. So that's a little bit of my background and how and why I understand these things, not just from an academic standpoint, but from a real world standpoint. So with that, note that the second half of this conversation is probably going to be a little bit more opinionated, but the first half we're going to dive into now is what this rate cut is going to do, okay? Right now we're living through the longest bull economy, right? The longest rising economy, growing economy, booming economy here in the United States that's ever existed, okay? We're coming out, we just passed 11 years of the boom, and, we are seeing a lot of economic growth here in the country, right? Partially because of, what the political administration's agenda is in terms of what their party wants and how they believe the business in the country should run. It has a lot to do with boosting the economy, and so we've seen that happen. Also because we've had a lot of post-recession growth, right? Post-housing market crisis growth, and we've had a lot of technology, which has boosted not just IPO offerings, initial public offerings, but has boosted the economy very heavily, and I don't want to use the term artificially because that's not totally true, but in a way that is tied hand in hand with extreme exuberance or euphoria. And I'm going to get into that in a second, which is why I don't want to dive too deep. But then partially, and this is the part we're really going to focus on today, partially because the administrations, not just this administration, but the administrations since 2008, the political administrations here in the United States, have realized the importance of the Federal Reserve, the interest rates, and what rate cuts can do to boost an economy. Okay, so I'm no economist. I'm not going to claim to be an economist, but I genuinely do my best to read as much as I can on general economic principle, and with an MBA and a certificate in finance, I have a good bit of understanding as to overall economic theories and fundamentals that you need to understand this stuff. So I'm going to try and make it as simple as possible, but in layman's terms, in the very easiest, simplest ways that we can put these things, when the Fed cuts interest rates, what you get is you get a pop, you get a boost in the economy, right? And a lot of very smart finance folks will look at that and say, okay, well, that's great, and it's going to continue because now we have lower interest rates, we have more people that are willing to spend, that's going to put more money into the economy, more people that are willing to invest, that's going to help business boom, and that's good in theory, okay, but you have to start to wonder for how long can you manufacture that, right? It's not forever, right? We've had negative interest rates before, but it's never forever. You can't cut to the point where you never have to raise again. That's impossible, right? Historically, it's impossible. Theoretically, it's impossible. And if you think about it just from a common sense standpoint, it's impossible, right? What goes up must come down. What goes down must come up. All these kinds of theories, if you will, on interest rates continuously being cut so we can boost the economy are rooted in the fact that they're going to lead to other things that will boost the economy for the long term. In general, an interest rate cut is a relatively short term, and I'm not talking short term like a few months, I'm talking short term, a few years, whatever it is, but rate cuts in general are not meant to be the end-all be-all solution to boosting an economy, okay? So when you hear a story like this, okay, and we've just been cutting rates for so long now, it kind of starts to make you wonder, at what point is this manufactured momentum going to kind of run out, right? And it's not going to run out right now, because if we get this quarter point cut, which we have the announcement today, when we get this quarter point cut, what's going to happen is exactly what we just said. There's going to be additional consumer spending, there's going to be additional investment, there's going to be some kind of a boom in the economy. We have the Dow at highest levels it's ever been at. We have a booming U.S. economy, 11-year bull market, like we were saying. This is going to add to that. This is going to contribute to that. This is going to add fuel to the fire. We're going to keep things going, okay? But now when we kind of flip to the other side and we start to look at the previous point I made and how this correlates with technology, right? We have ridiculously high valuations, on not just technology stocks, but in the U.S. stock market in general. We have pretty crazy high valuations right now. We have ridiculously high PE ratios, okay, for technology companies specifically, which a lot of these technology companies don't have a path to profitability, don't have a really sustainable business plan, so it just makes you wonder, okay, well, how long can this continue? How much of this is a house of cards versus how much of this is safe growth? And, we have debt levels rising in a lot of these corporations to unprecedented levels. Okay, a lot of what we're seeing, especially in the technology stocks today, is reminiscent of what was going on just before the dot-com bubble. Right, and so there's a lot going on there. And so when you look at those metrics, and I don't want to get into each and every single one of those today, but just know that basically any metric that you pull up to value today's technology stocks, if you look at the same charts, you'll notice that in 98, 99, you had the same kind of thing going on just before the dot-com bubble. You can correlate it pretty closely to what was going on in 2006, 2007, before the housing market crisis. You can even go all the way back to the 1980s when we had junk bonds and that crash, and you can really start to correlate the data, and you can see that we have the makings of a modern-day bubble, right? And so when we look at these things and we hear that the Fed is continuously cutting interest rates and we're on the precipice of potentially a bubble of, something that has made up 75% of new listings on the New York Stock Exchange, technology, which could potentially be a house of cards, it just starts to make you wonder. It starts to make you almost worry a little bit as to, okay, well, how good is this for the overall economy, and how much are we not paying attention to potentially what's going on underneath the surface? Right? Because cutting the interest rates will be good. We'll get a short-lived pop, but how long will it last? And how much are we contributing to potentially something that's relatively toxic? Okay, and we'll talk more about that on the program. So, stick with us at Starter Financial News because it's a recurring theme for us, something we've been covering for the last year and a half. But to kind of get into the second half of this conversation, what this means for us as entrepreneurs, because that's enough pontificating on kind of the overall effects of what, it'll have on the economy, what this means for us, right? How this affects venture capital, how this affects startups, how this affects entrepreneurs, how this affects us. What does this mean for us? Because you could watch all day long the same pontification that I just had on CNBC. You could see it on Fox Business, right? But they rarely, if ever, are able to translate that to what it means for us, entrepreneurs, right? The market players. So to discuss that a little bit here so that we can make sense of this, so that we can make heads or tails of this. So what did we just discuss? The Fed's going to cut interest rates a quarter point, okay? We're going to have cheaper money. We're going to have more money flowing in the U.S. economy. We're going to have increased borrowing, and we're going to have additional spending. All three of those things, okay, more free-flowing money, additional borrowing, and consumer spending are golden, are beautiful, are wonderful things for entrepreneurs. It's what we want. It's what we desire. It's what we need, right, especially for startups. Why? Because, number one, with the additional free flow of money, you have more investors. Right? Number two, with the additional borrowing, you now have those two things combined, additional borrowing, additional investors, to continue to support these mega behemoth VC funds that aren't necessarily valued on their returns or on their exits, but are valued mostly based on the size of their fund, how quickly they can deploy that capital, and the few companies in there that make it to these unicorn statuses. We can continue to sustain and support that model while this economy is booming. Remember, it's only been 11 years, right, that this has really been going on with these mega VC funds, because this bull economy, we've never had to deal with this in a bear economy. But this is basically, this interest rate cut is going to allow us to continue that. Right? We're not saying that it's good. We're not saying it's healthy. We're just saying that it's going to allow us to continue with the crazy amount of money flowing into VC funds and eventually flowing into our companies. Okay, so really what we have to pay attention to here, just on those first two facts alone, we'll get into consumer spending in a second, is that right now, folks, in all honesty, probably, if you're considering raising capital for your company, it's probably still the right time to do it. Be aware that it may not last, but if you think you have an exit plan where you can get out in 18, 36, maybe even 48 months, right? We're predicting on our end here with the research that we've done with the analysts that we work with, that we're looking at another 3 to 5 years boom in the economy if the Fed continues to cut interest rates and if we don't have a changeover of political administrations. Okay, that's just the really baseline, without getting into any kind of depth analysis that our firm has made. Okay, so if that's the case, as entrepreneurs, we have to kind of realize two things here. Number one, do I build my company, so that it's recession proof, regardless of if the economy goes up or down, that I can still build it. That typically tends to be more of a lifestyle company, is what they call it in Silicon Valley, which means you're not going to scale from 0 to 100 million over the course of 2.5 years, but you may be doing 20 million in sales in year 4, but that's not fast enough growth for Silicon Valley, right? But it could be fast enough growth for you. You could be pocketing $1 million a year with a $20 million run rate in revenue. Interesting concept to think about. Not popular in Silicon Valley. I talk about this in my book, First Money In. I don't know about you folks, but $1 million a year, even with stuff I'm doing now, would still change my life. Right? So it's something to consider. Now that being said, if you have a true, pure technology startup that is designed to work with this machine that we've created, meaning that you need to raise capital basically every 6 months, and you're going to scale and ramp up, and you're going to play that high growth, high risk game of trying to get an exit or an IPO in 18 to 36 months, what we're saying is that now is probably the time to do it. Considering the Fed is signaling this, considering we're getting this rate cut, go for it now. Don't delay. Now should be the time that you're raising. And folks, like I said at North Star, we work with between 40 and 50 startups a year. Okay, so we see this stuff all across industry, all across different companies. We are advising our clients, right? Our consulting clients, we're saying, look, now is the time, if you have a pure startup, to go out there and try and raise that capital, because the money is cheap now. The money is flowing. All right, so that's kind of the first thing we have to pay attention to. The second thing here, talking about consumer spending, is that's good. Any of you that have a new B2C startup, right? Anybody that is creating a new hardware product that is designed to target consumers, economy's booming. Interest rates are going down. Stocks are probably going to pop. So at this point, if you're doing anything related to the consumer sector, i.e. you're not a B2B business, you're B2C in any way, shape, or form, now is the time to get out there and try and push that product, because we have disposable income. Right? We're going to see a boost in disposable income here. Jobs economy is great. Okay? Like we said, interest rates going down, money easier to borrow, people borrowing against their home, their assets to do more spending. This is America after all. And additional money is going to be flowing into these consumers' pockets, which they are going to want to spend. So now is a really good time for these two things. Again, number one, if you're fundraising as an entrepreneur, you're doing a startup that you want to scale, now is probably a really good time for you to get out there, because the money is cheap and the money is flowing. Okay, it's a little bit harder to get it these days. I don't want to get into this because this is a different topic. For the earlier stage startups, you may be struggling. If you're doing anything really under Series AA2, that's what we specialize in at North Star. So if you have any interest in working with us, you can let us know. But we focus on anything below Series A. Series A and below in terms of fundraisers. But regardless of that fact, there's plenty of money flowing in the world of venture capital, in the world of entrepreneurship. This rate cut signals to us that it's going to continue. Right? That's what this whole special edition of this program is today, is to discuss what it means, and that's what it means. It means really those two things there. Number one, that now you should be fundraising. Number two, if you're doing anything related to consumers, you should be pushing the hell out of it now. You should really be considering leveraging everything that you have to try and hit the consumer market hard, because this seemingly unimportant story to a lot of you entrepreneurs out there, because that's how I used to treat this stuff. I used to look at this stuff. I used to look at the dollar-yen exchange rate. I used to look at the dollar-yuan exchange rate. I used to look at overall macroeconomic stories and say, well, what does the Fed matter to me? What does the exchange rate between the U.S. dollar and the Chinese yuan mean for me? And I used to think nothing. But then when I made the jump to this investment banking side, this venture capital side, I said, wait a minute. A lot of these venture capital firms have a massive, massive arm in China. And they're pulling money in and out of China all the time. So I need to know what's going on with that exchange rate, because that affects how much money they can put into my company. Same thing with the interest rates with the Fed here. I didn't realize how much this impacts the private sector through not just the financial marketplace, but through the venture capital marketplace, and all the way trickling down to us with startups and startups and entrepreneurs. Right? And the last thing to really touch on here, and it's not as relevant to a lot of the pure startups out there. And what I mean by the pure startups, I mean the tech startups that are, trying to play the Facebook, Uber, Lyft game, Snapchat, whatever it is. And this plays a little bit more into the lifestyle side of things, but debt is going to get cheaper as well. Right? And so if debt gets cheaper, you have an opportunity as an entrepreneur, if you have a good cash flowing business, to maybe lever up your debt a little bit, i.e. bring on some more debt so that you can maximize your returns. That's something else to consider when you get an announcement like this that the Fed is going to cut interest rates. And really the last piece we want to touch on here, and why this is such an important video and why this is important to put out now and why you should be paying attention to it as an entrepreneur, is because there's no promise that this is going to continue for a super long time. Right? We're kind of at the height, we just said, at the height of this bull economy for the U.S. We're definitely at crazy high, ridiculously, as far as we're concerned from an analysis standpoint, unrealistic and unsustainable valuations for tech companies. So that's something else we have to be aware of. And more than likely, we're at a height for funding. We've seen unprecedented sizes of venture capital funds being raised and unprecedented amounts of money being, flowed through private investors into young companies. And so the question is, how long does this last? Right? And the answer is, well, nobody knows. I don't know. People on CNBC don't know. The people on Fox Business don't know. The smartest chief economist doesn't know. The smartest financial person doesn't know. The dumbest person doesn't know. Nobody in between knows. There's no way of knowing. If there was a way of knowing anything that would happen in the economy, you'd have much more millionaires across the globe. Okay, there's just no way. There's predictions. You can make analysis. You can run spreadsheets, which we do, and we're predicting that if all goes smooth, if you will, the Fed can continue to cut interest rates a few more times like the president wants, and we don't see a major shift in geopolitical events, and we don't see a major shift in political changeover, if you will, in 2020, we're saying, all right, probably another 3-5 years, boom, if that, max. But the fact of the matter is markets are cyclical. There's going to have to be some kind of a correction. We have certain metrics, certain levels that are just far too high that have to correct, so that even if we don't have a recession, we have to have some kind of correction, okay? So if that's the case, right, what we're trying to say in this program is pay attention to what's going on. Now you understand what what stories like this, how they impact you, what something like the Federal Reserve's interest rate can do to you as an individual entrepreneur, a seemingly insignificant small part of the economy that this actually has a major effect on. Pay attention to what you can do now to leverage and maximize what you have in front of you, right? And if you're thinking about just getting started, like a lot of people that watch this program, consider these factors before you start to rely too heavily on any one investment sector, on any one measure or vehicle for raising capital. That's the term I was looking for. And pay attention to really what your trajectory is, right? Because that's the most important thing. Try and think about the fact that, we've mentioned these things that we're at these crazy heights, but also that we have this, cheap, accessible money, and try and position yourself somewhere so that you can sustain yourself, based on your strategy, regardless of whether or not the economy goes up or goes down, because there's just honestly no way of knowing how much longer it can go up, right? So, a lot of people don't like to hear that, and, there's arguments all the time on the major news networks about that, but, it's a fact. It's a fact of markets, they're cyclical, and that we're going to see some kind of correction at some point. So, in any case, that, folks, is how this seemingly insignificant story affects you. That is how the Fed cutting interest rates by a quarter point is actually a major piece of news for you as an entrepreneur. And this is kind of the stuff that we have to be paying attention to as startup founders and as entrepreneurs, because if not, we could very easily be blindsided by overall economic events that we may not be able to predict, just because nobody's putting this information out there. And that's what we're trying to do with Startup Financial News. That's what we do with North Star for our clients. Obviously, they pay us for that, right? But here, you get it free on Startup Financial News, so we can have conversations like this. And if you do need additional help, you're more than welcome to contact me, contact North Star. But for the time being, just try and make sense of what these stories, what these geopolitical events, what these economic events could mean for you as an entrepreneur, because the most important thing you can do is stay informed so that you can make the right decisions moving forward and kind of predict the trends that are going ahead, right? We talk about that all the time on the show. You want to be able to look not just a few months, but potentially a few years ahead to find some kind of trend, to find something that you can exploit as an entrepreneur to make a good bit of money at, because that's how really good entrepreneurs do it. And you can get a lot of clues if you know what to look for when you're picking up a copy of the Wall Street Journal and you're looking at a story like this. And I hope, as the host of this program, that this program not only helps to make the daily news and the stories that we cover more digestible for you, but helps you to, on your own, understand when you read these things, oh, wow, okay, let me dig a little bit deeper and see how this could affect me. Because like I said before, I had no idea that the Chinese yuan, US dollar exchange rate affected me at all when I was running my last company, but it did. And it did impact it severely. So, folks, on that note, I'm going to end this special Saturday episode of Startup Financial News. Like I said, it's our first one exclusive to YouTube. If you have any questions whatsoever, I know there's comments on YouTube. You can leave those there, but sometimes I think the easier thing to do, especially because this is a business program, is email us. It's going to be startupfinancialnews@gmail.com. I'm your host, Julian Meyer. Somebody on our staff will make sure to forward that to me. So again, it's startupfinancialnews@gmail.com. And I do my best to reply to those within 24 to 48 hours. Can't always get to them, but try my best. Like I said, if you want additional in-depth help on this, if you're running a startup, need more information, you can check us out right now at mgifinancing.com. Like I said, that's MGI Capital, the firm that I've been running for the last 2.5 years, soon to be called North Star. So that is another place that you can reach out to us on. And aside from that, feel free to subscribe to the podcast. Startup Financial News on Apple iTunes, on Google Podcasts, basically anywhere you can get your podcast, you can find it, Startup Financial News. And, if you have any entrepreneur friends that, are actively running a business or thinking about running a business, please share this video, share our resources with them, because, this is the information in the news that entrepreneurs need that just doesn't get out there on the major, news networks, and it's what we're trying to bring to all of you, to our audience. So thank you for tuning in. Hope you have a wonderful weekend. Again, this has been a special Saturday, July 20th, 2019 episode of Startup Financial News. I'm your host, Julian Meyer, and I'll be right back with you here soon for another episode of SFN. Take care.